yellow subsidiary now. We are now solving one question. We are going to be solving past question, and that's how we are going to do it. So please let's start. Let's start. Group account. Please, before we start again, please everybody, I want you to mute yourself. We are all professionals. We are all chartered accountants in making. It's just a timing difference. So please, let's be professional. Let's unmute ourselves. If you have any question, please, we can just signify. Then we can now start now. So group account. So let's move my first slide. My next slide. Uh, okay. So
there is a way you can take this to a presentation mode so that for those people that are joining on YouTube, they can be able to see it clearly.
Yes.
Also in presentation mode, and you zoom in, or maybe
Yes.
you zoom out so that this 59%, you can take it to like 100 or 120.
Okay.
So for those people joining on YouTube, so that they can see clearly.
Exactly. They usually complain. In fact, I usually receive a lot. I actually forgot.
So you can take it to 120. And next time, as you are preparing this slide, since you will not be writing, you can make it more bold so that at least as much as slide you can have, as much as many. The bolder, the better for their own advantage.
Okay, sir.
So click on the presentation mode. Presentation mode is the one beside the percentage. You can go down. Presentation mode is the one beside the percentage. That percentage, they have 172.
Okay.
Just click on that. Yes, it will go to presentation mode.
Okay. This is
that one. No. That one. No. That one. Before that one.
Before? Oh.
No. As if you go by your right.
My right.
You go that one in between. Yes, that one. Click it. Click on it. Okay. I don't think it's working. Please continue.
I don't think it's working. I've actually tried it. So but can people see my screen?
Yes, you can.
Yes, sir.
Yes, you can.
Yeah.
Okay.
Yes, we can see.
So let's continue. So group account. For today, we are just going to be like refreshing our memories. Talking about how group accounts arise, what are the requirements of group accounts and the likes. So I think my screen is now, I think I've enlarged it. Okay.
The former was okay.
The former was okay, right? Okay. Okay, let's start. So now, first and foremost, please don't let us because of group accounts is all about calculations. Please don't let us neglect our written aspect. Who is trying to talk? Please let's mute ourselves. So there are three standards that discuss about group accounts. The first is IFRS 3 that deals with the fundamental principle of consolidation. Then IFRS 10 deals with the preparation of consolidated financial statements, while IFRS 7 is disclosure on consolidation. And fortunately, that was what you guys did on Tuesday, IFRS 7. So now we are going to be discussing about the key terms in group accounts. So the parent company, the subsidiary company, this consolidated financial statement. So now let's bring it one after the other. Now, who is a parent company? Just like in a late term, the way I explain group account to people is that this life is not balanced. This life is not balanced. There are two sets of companies. One is company A, while the second one is company B. In a single man term, if you want to explain group account to somebody, that's the scenario I'm painting now. Company A is financially buoyant. He has a lot of profit. He has a lot of asset and the likes. While company B needs money. Company A have money. Company B needs money. So as a company, as a public liability company, for you to raise money, you can issue out shares. You can issue out shares. You can raise money through equity or through debt. So when you want to raise money through equity, you sell out your shares. So unfortunately or fortunately, company A now bought, company A is financially buoyant. Company A now go to company B. I want to buy your shares. So immediately, company A buys more than 50%, more than, even though it's 51% of the shares of company B. It is assumed that company A has gained control over company B. So in this scenario, company A is the parent company, while company B is the subsidiary company. Whenever a company that is financially buoyant, that has a lot of assets, buy the equity shares of another company, it gains control. So control. So now our first terminology we are discussing about is parent entity. That means the parent company. Who is a parent company? A parent company is an entity that controls. Can you see? That control is very, very important in group account. That control, when we go to subsidiary, we are going to understand where we are going. Where we have two types of control. We have direct control, then we have indirect control. In the sense that we have a ultimate parent company and intermediate parent company. So that's where we are going. And that's what I said in my first class, that group accounts in corporate reporting for people moving from skill level, group accounts is now complex. You are now dealing with complex group structure. The group account you did in your skill level is not group account, it's just like an introduction. They are just introducing you to group account. But now you are now talking about complex situation. So our number one is a parent company, an entity that controls another entity known as subsidiary company. Then our terminology two is subsidiary company. Who is a subsidiary company? A subsidiary company is an entity that is being controlled by another entity known as parent entity. Now, number three, consolidated financial statement. Now, it is the requirement of IFRS 10 that when a parent company have a subsidiary company, it must prepare a financial statement. So that financial statement is called consolidated financial statement. That means a financial statement of parent and subsidiary prepared as if they are one entity. And that is where we are going. That is where we are going in this corporate reporting class. We are going to be preparing consolidated financial statement. That means the parent company and the subsidiary company. Why our terminology four is the associate. An associate entity is an investor that has a significant influence over the activities of another entity. That means an entity that bought or that purchased shares, which is an investment, but the percentage is between 20 and less than 50. Between 20%, you can regard that entity as an associate. So there is another topic, investment in associates. I think that's one of the topics we are going to retreat also. So why the last one is the control. Right? The control is what the right to power, the right or power to direct the activity of another entity called the subsidiary so as to obtain the economic benefits. Can you see now? Control. And that's the reason why when I define the parent company and the subsidiary, I highlighted the word control. That control is very, very important. Is the ability to direct the power to direct the activity of another entity in order to obtain economic benefit. And to gain the control, the investor must acquire what? More than 50% equity shares of the investees.
Sir, we can't see
Except,
the phone again.
I think that should be your network. Let me check. Okay.
The screen is showing.
Right? My
The
screen
screen
is
is showing. Check your network.
your network. Just calm down. It's going to come up back. I can see it here that the network
I'm not seeing it too.
It's your
it's the network.
network.
Don't worry, just calm down. It will come up. So no problem. Let's continue. The network is your network that is fluctuating. It will come up. So please let's continue. So having discussed about the necessary terminologies, I think we can move on to our next slide. So our next slide is okay. Let's talk about our next slide. Okay. The reason for preparation of consolidated financial statement. The reason why are we preparing consolidated financial statement? And this is what I want to say. There are some questions. Please, let's take notes. There are some questions that will contain 20 marks. Examiner will just do what? Examiner will just give you 15 marks calculation, then 5 mark written. These are where the 5 marks come from. I'm going to be discussing it. Number one, why are we preparing the consolidated financial statement? Some people just think that okay, we can just in practice, let's just prepare consolidated. There is a reason. It's the requirement of IFRS 10. IFRS 10 requires that a company having a subsidiary as its reporting date, the entity must prepare a separate account called publish consolidated financial statement, being the financial statement consolidating its own results with that of the subsidiary. I think I missed up something here. What they are trying to say is that IFRS 10 requires that when an entity, at every reporting date, when that entity has a subsidiary, you are a company, you have your subsidiary, you must prepare a financial statement called a consolidated financial statement. Being the financial statement consolidating your own results with that of its subsidiary. So you must prepare your financial statement that will join you and your subsidiary, that will picture you as one. It is actually the requirement of IFRS 10. Now, however, this is the first question. If I can want to test written part in group account, I can usually set this question. Condition that permits the parent company not to prepare a consolidated financial statement. There are some conditions that a parent company, that company is a parent company, but it's not required to prepare a consolidated financial statement. There are some conditions, and the conditions are as follows. Number one, the parent entity is an investment entity. That's condition number one. When the parent entity, that parent company is an investment company. Everybody knows that every business, for you to set up a business, you must have your business model. Some companies are trading companies, some companies are manufacturing companies, some companies are retail companies. There are some companies that provide services. There are some companies that are into agriculture. So you have your business model. So IFRS 10 is now telling you that when you are an investment entity, you are an investment entity, and even though you have your subsidiary company, please don't bother to prepare your consolidated finance. You are excluded. You are permitted. That is the first. When an entity is an investment entity, IFRS 10 says yes, we know. Don't worry, just stay calm. You don't need to prepare it. Why the second one is that if the entity is not an investment entity, that means the business model of that entity is other business, not investment entity. But that entity now met the following condition. Number one is if the entity is also a subsidiary to another entity. That's condition number one. That entity is a subsidiary to another entity. Can you see now? Now, in this scenario now, is that company B is a parent company, while company C is a subsidiary company to company B. However, now, company B is a subsidiary to company A. So that is what this point number one is saying. Company B, although company B is a parent company to company C, fine, we understand. However, it is also a subsidiary to company A. So IFRS 10 permits you that you don't need to prepare or consolidate since you are also a subsidiary, even though you are a parent to another person. Please don't prepare your financial statement. Then B, the condition B is that if the debt and the equity instrument of that parent entity is not treated publicly. If the debt, I said it earlier when I wanted to paint my scenario about group account, I said when an entity wants to raise money, in real life, when you want to raise money, you must raise money in two ways, through debt or through equity. Through debt are through bond, you go and issue out bond, and you go to bank, you collect bank loan, you collect debentures and the like. Those are debts. Why equity is when you raise shares. So now IFRS 10 is now telling you that when that entity, the debt and the equity instrument of that entity, of that parent, is not traded publicly. That means you are not a public limited company. If all of us can sit down and look at, and I know professionals, many professionals are here, you are hearing of First Bank PLC or Handle PLC, this PLC, those are PLC. When you are a PLC company, you must prepare your consolidated financial statements. But if your debt and equity instrument is not traded publicly, just like ABC Limited, 123 Limited, that nobody, your shares is not issued out to the general public, IFRS 10 says you don't need. You can just prepare it for your internal use. For your management, you can prepare it, but you don't really need it. Then C is that if that entity, if it is not in process, that means if the debt and equity instrument is not in process of being traded in the relevant stock market, that means of being traded publicly, that means if you are not in the process, there are some entities in which their debt and equity instruments are publicly traded, while some they are in process. We want to go to stock exchange, we want to start processing how we are going to be raising out shares to the general public, because there are advantage of trading your shares or your debts publicly. One of it is that you raise a lot of money. You raise large sum of money. If you need to collect trillion, your shares must be issued out to the public. So that's the advantage of your equity and your debt instrument being traded publicly. So that's point number 3. Why the D is that your ultimate parent has prepared the consolidated financial statement in with IFRS. And this point number D is somehow similar to A, your ultimate parent. Apologies, my slide didn't talk much about types of parent company, types of subsidiary company. There are two types of parents. I said it the other time. We have ultimate parent and the intermediate parent. In my scenario, company C is a subsidiary to company B. So company B is a intermediate parent to company C, while company A is a ultimate company, is a ultimate parent company to company C. You know, we have A, B, C. Company A is a parent to B, while B is a parent to C. So the relationship between A and C is that company A is an ultimate parent to C, while company B is an intermediate parent. That's where sub-subsidiary comes in. So we are going to solve question on sub-subsidiary, where a company we have a subsidiary, then we have a sub-subsidiary. So that company C is a sub-subsidiary of A because its subsidiary is B. So that's it. So I think let's continue. Let's move on. Shit. Now, this is just small heading. Consolidated financial statement. So the consolidated financial statement comprises of what? It comprises of the statement of financial position, the statement of profit or loss and other comprehensive income, then the statement of changes in equity. So we are going to discuss about financial position, discuss about profit or loss also, and changes in equity. And we are going to discuss about consolidated statement of cash flows too. I can have tested consolidated statement of cash flow for a very long period of time. In fact, people predicted that it will come out last diet or 2 diets ago. So please watch out for it. I can have tested it for a very long period of time. Consolidated statement of cash flow. And ICANN is all about surprise. They can surprise you guys now. Please, let's put it at the back of our mind. Even though if I do not remember, please remind me that I said I want to take you consolidated statement of cash flow. It's very important. It has been tested for a very long period of time. So let's move to the next slide. Okay. Our next slide is this number 1 is date of inclusion, and date of exclusion. Date of inclusion and date of exclusion. So number 1 is date of inclusion. So the date of inclusion is that subsidiary company is to be included in the consolidated financial statement from the date, the acquisition date, from the date the control has been obtained. I'm sorry. From the date control has been obtained. The date the parent company acquired 51%, you have to include the subsidiary in your consolidated financial statement. Then number 2 is uniform accounting policy. For effective consolidation, the parent companies, that is the group members, should have the same accounting policies. and for similar transaction. Note that the parent company will be using cost model for PPE, while subsidiary will now be using evaluation model. It doesn't make sense. They must use uniform accounting policy. Both of them must change to have the same accounting policy. Number 3 is similar reporting date. The parent company and the subsidiary must have the same reporting date. While number 4 is date of exclusion. That means the date the subsidiary will be excluded from consolidated financial statement. That means the day control was lost. The day control was lost. And that is another topic, disposal of subsidiary. Disposal of subsidiary. That's another calculation. That's another topic. Disposal of, I think I can tested it, maybe one diet like that. Is it not 10 marks? Or I think it's 10 marks. Disposal of subsidiary. That's what this point number 4 is called. It's a topic on its own. That when a parent company loses control, so it is assumed that that subsidiary, the control will be lost. And once control is lost, that means the of control reduce. There is no more control. So you have to remove that. You don't have to prepare consolidated again, because that company is not your subsidiary again. So now we are moving to the next item, principles for effective consolidation. What are the principles? And this is where I'm actually going. The way I was taught group account is very, very simple. Once you understand the principle, and by the grace of God, next week, I'm just praying everything should work out fine. When we start solving group accounts, for the people that I taught in group, in skill level, there is an approach we use to prepare our group accounts. And that approach is very, very fast and very, very straightforward. The only issue you'll be thinking about is additional information. And I'm going to give you some trick how to treat additional information. Even though some additional information is very thick, there is still a way you are going to, because any additional information must do what? Must affect the asset and the liability. Any additional information they give you, one must affect assets, one must affect liability. So you just link it. Is this asset, which asset are they talking about? Is it current asset and NCI? But just let's leave that one. When you start solving question, we'll talk more about that. So principles for preparing consolidated financial statement. Number 1 is that the asset and the liability of the parent and the subsidiary must be combined. That's a principle. We are joining the asset and liability of the parent and subsidiary together. Then number 2, only the share capital of the parent company will be shown in the consolidated financial statement. That's the principle number 2. Then only reserve, the retained earnings and other reserve, OCI of the parent company will be showed. Invariably, for point number 2 and 3, the share capital of the subsidiary company will not be shown in the consolidated financial statement. The reserve, for people that didn't do skill level, some people contacted me that they didn't do skill level, they are just moving to professional level. They just did there are some schools like that. They have this ICANN accreditation, or what do they call it? I've forgotten this name. So they just moved to final level. So please,
Agreement, sir.
Marketing exemption.
Okay, exemption, Abi. Yes, I know there is
Marketing
mutual.
exemption.
That's empathy.
Okay, yes. Like mutual agreement. Yes, there will be a mutual agreement between ICANN and the school that so once the student just graduates, you just move to final stage. And that's where I'm actually going, in the sense that when you actually did group accounts in your skill level, then you are now moving to your final level. I think you can cope little because you have done the basics of group accounts, you have known the basics, and you'll be fine. But people moving from that didn't do skill level, moving to final stage, I think you still need time to study this principle. And that's the reason why I'm explaining this principle for you. Because actually, I know you have done it in school, fine. Probably in your 300 or 400 level, you have done it in school. But now this is I can. And that's why I usually tell my and advise the people very close to me and my student that please just understand the principle. Don't try to cram. This consolidated financial statement is actually, once you understand the principle, you'll be fine. Please don't let us cram. Now, let's move to point number 4, the NCI. What is the NCI? NCI is called the non-controlling interest, formerly known as minority interest. So what are they saying? Example, sorry, excuse me. A parent company has 60% control. The 40% are NCI. They are called the non-controlling interest. So this NCI must be shown in the consolidated financial statement. It must be shown. Whether it is financial position or P&L, it must be shown. So that is what the point number 4 is talking about. Please, this principle is very, very important. Let's understand this principle. And that's why I want us to discuss about the principle tonight. Then by next week, we start solving questions. And we are moving to past questions because we don't have time. February is gone already. February is gone already. We have March, April. And we have a lot of topics to cover. So please, let's understand this principle. So let's continue. NCI will be shown in the statement of financial position. Then point number 5 is goodwill. Goodwill on acquisition must be shown in the consolidated financial position. That means consolidated statement of financial position. What is goodwill? Goodwill is like a future economic benefit that is always shown in the consolidated financial statement. Goodwill cannot be shown in your normal financial statement. I'm sure we are going to discuss about that in IS 38, intangible assets. Goodwill is an intangible asset. It can be used to manipulate financial statements. That is why it is prohibited that you cannot show goodwill in your financial statement, except it is acquired in a business combination. That's a requirement of IFRS 3. So goodwill on consolidation, which is positive goodwill, must be shown in the statement of financial position, while the negative goodwill, that means gain of bargain purchase, is shared between the parent and the subsidiary, depending on the circumstance. Please, depending on the circumstance. We are going to solve questions that might give us negative goodwill. Although IFRS 3 told us that when you have a negative goodwill, please don't be fine. Please don't be fine. It might be that you might make mistake. IFRS 3 says that when you have a negative goodwill, you can go and read any IFRS, go and see it is stated there that when you have a negative goodwill, please don't be fine. IFRS 3 says that you should go back. Please go back. Go and recalculate your goodwill to check. Maybe you do not make any mistake. So when you now calculate for the second or third time that you now get your negative goodwill. If I still now say, okay, yes, you are now fine. You are fine. Now go and take that negative goodwill, take it to the parent company reserve. That means under retained earnings. If the NCI is valued at goodwill, but if it's valued at proportionate net asset method, you should share it between the parent and the subsidiary. So, but we are coming there. I just want to make mention of it. Okay. Let's discuss about the last. Okay, that's not the last. Unrealized profit should be. Please, please, who is this? Please, who is unmuted? Please mute yourself. Please mute yourself. Please, Mrs. Modupe or Mr. Modupe, please, can you mute yourself? Gosh.
This is the way they gave us specimen.
Sir, can you please remove him? Remove her, please.
That's actually what I want to do, actually. I think I have
Just mute everybody from this call. Mute everybody so that nobody will disturb the class.
We are all adults. Please, you don't have time. So please let's move on. Unrealized profits. So the parent company and the subsidiary company, they will do transaction with each other. Transaction will occur between each other. So when a parent company or a subsidiary company sells to its group members, that means the parent or subsidiary at a profit, it is assumed that that profit is unrealized. It is unrealized. So any profit arising from the transaction between both of them will be eliminated. So it will be subtracted. So when we are solving question, I will remind you guys. Why the last one? I think the last one is intercompany balances. That means when they are owing each other, parent company is owing subsidiary company 1 million naira, while the subsidiary company is owing this one 1 million naira. IFRS 10 said no, you should eliminate it because they are regarded as one. Both of them are one. The parent and subsidiary, they are one. Please eliminate it. So when you see balances between each other, you just eliminate it. And what is elimination? You just minus. So when we are solving, you just remember it as minus. So let's continue. Okay, I think that's done with that slide. Now let's move to the next aspect. Now, separate financial statement. Separate financial statement. Okay, before that, I can see somebody's hands up the other time. Who is is it okay? Okay, okay, Mr. Benjamin, can you quickly ask your question? I think let's take like
Okay.
2 questions before then we can continue. Okay.
All right. Good evening, sir. Good evening, colleagues. Thank you very, very much for the explanation so far. So
Yeah,
my network was kind of breaking. You mentioned something about date of inclusion, uniform accounting policy, similar accounting date, and date of exclusion. So I want to really understand under what subcategory does these 4 items fall under? I didn't
okay.
really get that. My network was breaking.
Okay.
Now it's
That's the
shutting.
rule. The rules for effective consolidation. The rules for you to consolidate effectively. What are the rules? So that's it. And the first is date of inclusion. The day you gain control. The day you get control IFRS 10 says that you must include your subsidiary in the consolidated financial statement, the date. Then the second one is uniform accounting policy. And what is uniform account? Both of you must have the same accounting policy. That means when you are dealing with your IAS 16, when you buy IAS 16, when the subsidiary buy IAS 16, when the subsidiary is using cost model, the parent company must use cost model too. You must use the same accounting policy. That's the uniform accounting policy. Then uniform reporting date. Both of them must have the same reporting date. Your year end is 31st December 2020. Year end 31st December so year. Your subsidiary to it must be the same. Why the date of exclusion? The day you lost your control, the day you lost your control, you are to eliminate your subsidiary. That means that person, you are no longer the parent company. So that's where I actually talking about disposal of subsidiary or investment on associate. Because if you have 52% before you gain control, then you now lost like 5% control. You now slash to like 48%. So you are an associate. So you have to prepare investment in associate. That's another topic. So that's it. So let's the next person, Mr. Oladipupo Rashid.
Good evening, sir.
Good evening, sir.
So please, I just want to ask, can we get this material afterwards?
No problem. I will send it to you immediately. I'll send it to you.
Thank you.
All right. So, okay. I think that's the last question. I think we can continue our class. Please, let's continue our class. I just feel before let's just ask almost 1 to 2 questions. So, okay, let's continue our class. Now, IAS 27, separate financial statements. So actually, I discussed about about an heading that there are some entity that are permitted not to prepare a consolidated financial statement. So that entity, if you are not preparing a financial statement, IAS 27 says that you must prepare a separate financial statement in line with IAS 27. And that's what this heading is saying. A parent company that did not prepare a consolidated financial statement as a result of exemption rule. I listed those rules. Please, let's make sure we hold that rule. I can usually test it at 5 marks or 3 marks. It's just a bonus mark for you. When you see it in the exam, just clear it. 5 marks, what's the law? Then now solve question. It's 50 marks. I can remember when I wrote my exam, I don't have time to read. I was very, what did I get? I said I get 55 or 56. I have passed. So please, all these small things, let's hold it. Let's just keep it somewhere. I can't just set 3 marks question or 2 marks. Just clear it. It's something. Join it. More than one. Join it. You have gone. So that's it. So in line with IAS 27, the separate financial statements may measure the investment in subsidiary, the investment in joint venture and associate, either at cost or fair value in line with IFRS 9 financial instrument or using the equity method in line with IAS 28. So when a parent company is exempted to prepare a consolidated financial statement, so IAS 27 now says that you should prepare your financial statement called a separate financial statement. Now you should now measure that subsidiary, that investment in subsidiary, measure it in line with IFRS 9 at fair value or cost model using IFRS 9 or using equity method in line with IAS 28 investment in associates. So this is just an heading you should just understand that when a parent company is not preparing a consolidated financial statement, not that you now go and sleep. You are now not going to prepare any financial statement. So this is what IAS 27, although in practice, So many companies don't prepare separate financial statement. They'll just prepare their normal financial statement. But this is a requirement of IAS 27. So now goodwill. Let's move to goodwill, concept of goodwill. So IFRS 3 defines goodwill as an asset. I said it earlier, goodwill is an intangible asset. Intangible asset. And the standard that talks about intangible assets is what is IAS 38. Intangible assets. IAS 38 discuss in details what is intangible assets, types of intangible assets, the recognition criteria, the measurement basis, and the likes. So, but IFRS 3 defines what is goodwill. And goodwill is an asset that represents future economic benefit arising from other assets in a business combination, which are not individually recognized or identified. That's the definition in line with the standard. That's the line. The definition is a future economic benefit arising from other assets acquired in a business combination. That is what I'm saying. Goodwill is not recognized and should not be recognized in the financial statement because you can use it to manipulate your financial statement. I can say my goodwill is 1 billion, whereas it is a lie. It is a lie. How do you arrive at 1 billion? Can you measure it? It is a lie. In reality, it is a lie. So that is why the standard says that you cannot recognize your goodwill. If you see financial statement, you can't see goodwill there. Except you acquire another company. That means business combination, a transaction that occur in line with business combination. So that is where goodwill. Then when that goodwill arrives, IFRS 3 says that you can now show it. Sorry, IFRS 10 says that you should show it in your consolidated financial statement. So now recognition of goodwill. When should we recognize goodwill? When should we recognize goodwill? So IFRS 3 says that goodwill should be recognized as an intangible non-current asset in the statement of financial position only when it arises from business combination. Only when it arises from business combination. That means when you are a company, no matter how Wando PLC, First Bank PLC, and this one PL, Kinicon Limited, you are now saying you have a goodwill. It's a lie. You don't have any goodwill. You cannot measure it. Fine, you might have a goodwill. Example is Dangote. Dangote PLC. When you hear Dangote enough, even though Dangote start doing one business now, and they call it Dangote back, just Dangote start manufacturing back or start manufacturing drinks. Just like Pepsi, all these drinks that we drink, or water, bottled water. They now call it Dangote. The moment you hear that word, that Dangote, that brand, that name is a goodwill. It will bring future economic benefit. That means it will bring more money into the business. That is goodwill. When you just say, Dangote is selling water now, you want to buy it because it's Dangote. That name alone is a goodwill. It cannot be seen. That is why it's an intangible asset. We cannot see it. But when you hear it, it will bring future economic benefit to the business. So that is why IFRS 3 is saying only when it's acquired in a business combination. Please don't recognize it in your financial statement. So let's move on. Now, initial recognition of goodwill and subsequent measurement of goodwill. Now, number one, at initial recognition, goodwill should be measured at fair value at the date of acquisition, being the date control was obtained. So remember that goodwill can only be recognized in a business combination. So when the date of control, the date of acquisition, the day you acquire a subsidiary, you should measure your goodwill at fair value. Then at subsequent measurement, that means after a year or after 6 months, goodwill should be measured at fair value less accumulated impairments. That is IAS 36. Goodwill impairment. Goodwill usually impair at the end of every year. You see impairment, then that's it. And please let's take note, goodwill cannot be sorry, goodwill cannot be reversed. Goodwill cannot be reversed. And let me quickly chip in what this means. This year we have a goodwill of 5 billion naira. Then we now did our impairment. We did our impairment assessment. You remember you are a statistics, impairment triggers. We have internal and external. We suspect that this goodwill might be impaired. So when we now did the impairment, we now got an impairment of 1 million. So the carrying amount of your goodwill at the year end will be what? 4 million. That means 5 million minus 1 million, 4 million. So next year, you now calculate your goodwill. You now see that your goodwill has increased to 5 million or 6 million again. You know, last year it was 4 million. So what IFRS 3 is now saying, or IAS 36 is now saying, is that your goodwill cannot be reversed. You cannot reverse it back to 6 million again. It remains that 4 million. That 2 million, we now go and touch. When we discuss about IAS 36, you are going to understand what I mean in details. But in a short form, goodwill can never be reversed. When a goodwill is impaired, it is impaired. You cannot reverse it again. So determination of goodwill. How do we calculate goodwill? The cost of investment is subsidiary by the parent company at NCI value at DOA, that means date of acquisition. There is a value, the value of your NCI at the beginning, at the date of acquisition, it is called NCI value at DOA. It is usually given, or it can be calculated. We are going to be discussing about that. You add it together, you get your purchase consideration, then you less your net assets of the subsidiary, then you get your goodwill. So if you can see my calculation, my goodwill can be positive and it can be negative. My goodwill can be positive. If it is a positive, IFRS 10 says I should go and recognize it in my statement of financial position. But if it is a negative, IFRS 10 says what? Please don't be comfortable. And I'm saying it again, anytime you are calculating your goodwill in your exam, when you now get negative, please don't be comfortable. Please go and calculate again. That's the requirement. Go and calculate again to see maybe you did not make any mistake. Then when you now calculate the second time, you now say, okay, I did not make any mistake. IFRS 10 now say, yeah, go and recognize in the retained earnings. So let's move on to the next item is type of goodwill. Just like I said, positive goodwill. We have the positive goodwill. Now, this is the excess of purchase, fair value of purchase consideration on acquisition over fair value of subsidiary identifiable net assets. The excess, that means your purchase consideration is higher than the net assets. You get your positive goodwill. And positive goodwill is an asset and should be recognized in the non-current assets section in the SOFP. So goodwill should not be amortized, but should be subject to test for impairment at least on an annual year basis. That's what I said earlier. At the end of every year, you must impair your goodwill. You must test it. You must assess it for impairment at the end of every year. That means at least annually. But you must not amortize it. You remember that your intangible asset is subject to amortization, just like your PPE is subject to your depreciation. So, but goodwill should not be amortized, but should be tested for impairment. So that is positive goodwill. Then we are moving to negative goodwill. This is the excess of what? The fair value of subsidiary identifiable net asset over the fair value of purchase consideration. So, and according to IFRS 3, negative goodwill is an income. Positive goodwill is an asset. Please, let's remember, is an asset. While your negative goodwill is an income and should be recognized in your consolidated retained earnings. That is your negative goodwill. Then that is goodwill for you. So the last is non-controlling interests. I think we need to discuss about this non-controlling interests. Non-controlling interest, NCI. It is very, very important we understand non-controlling interest. And what is non-controlling interest? Okay. 1010, I think. Okay. I can see hands up. But let's finish this. Let's finish this discussion. Then I can now take question. So I can see question. Let's finish the discussion. Just like I said, next week we are going to start solving question next week fully. We are going to start solving question, past question next week. So today we just want to discuss about the various principles and the various written aspects of group accounts. That's what we are actually discussing about. So NCI. So for you to understand group account, I think you must understand what this NCI is talking about. And please, if you don't understand this NCI, please try and understand. Because the moment you don't understand this NCI, problem will start. And by the grace of God, we will not have problem. For you to understand group account, you must understand NCI. And I like explaining things in a layman term. A parent company, a company that has 70% control. 70% control. So when a parent company has 70% control, what they are saying is that when that subsidiary company has a profit of 100 million, when that subsidiary company has 100 million as profit, parent company will have 70%. We have 70 million of that profit. The remaining 30 million is for the rest. The rest, they are called the minority interest. They are called the non-controlling interest. The rest. So this NCI, there are various methods of valuing NCI in consolidated, on consolidation. Let me just use that word, on consolidation. For we to value our NCI, we use two methods. Method one is the fair value method, which can also known as full goodwill method. While method two is what is the proportionate method. The proportionate net asset method. You can call it proportionate method. You can call it net asset method. I'm going to discuss about this. Let's just keep calm. So now, number one is fair value method. That fair value method can also be known as full goodwill method. In this method, NCI is valued based on subsidiaries' shares. Based on subsidiary shares. That means when they want to value that NCI, it is based on shares. And the calculated goodwill, when you get your goodwill, the goodwill belongs to both parent and subsidiary. Please, let's take notes. When you are using full goodwill method, the goodwill belongs to parent and subsidiary. And any loss on impairment will be suffered by the parent and subsidiary. Just like the name, full goodwill, both of them, they will be affected. They will enjoy the reward and they will bear the risk. Just understand it. Full good method, two of them, they will face it. Now, for examination purpose, that's where the problem usually comes from. This NCI method, the moment you understand NCI method, I don't think group account will give you issue. Even though sub-subsidiary, even though fellow subsidiary, I don't think you have any issue because you have understand 50%. You understand where you are going. So for examination purpose, NCI value is usually measured based on group policy, based on parent company policy. Because let me tell you a secret. It is in skill level they will be telling you the group policies that it is full goodwill. When you are in professional level, nobody will tell you. When you see complex, when you see technical professional exam, nobody will tell you that this is the policy of the company. And if you do not know policy of the company, you can never solve consolidation because there will be a problem. And that's why I said this value method of value NCI is the major issue, one of the major issue of group account. Once you can understand it, you will be fine. And that's why I actually added this note for examination purpose. You are going to use full goodwill. That's why I'm saying it, that nobody will tell you because they will know that you are a professional. You are no more in skill level. Then you are know that you are now a agbalagba. You are now boss. You are not no more an amateur. That they will tell is in skill level. They will be telling you it is the group company policy. Fine, there are some questions that they will tell us the group. But if you see technical questions, they are not going to tell you good policy. You are the one that will think. You think outside the box, you look at the question, and you will know that okay, it is full goodwill job, and it is net asset method. You will know once you understand. And that's why I put this note into practice. Number one is that where goodwill attributed to NCI on acquisition is given, there are some times, that's where I'm going, there are some technical questions. I think we have to solve questions like this. In the question, they will give you goodwill. They will tell you that the goodwill attributed to ABC company, that means the subsidiary or the NCI, is so 10 million. They will give you. You know, when you are in your skill level, you cannot see goodwill in your question. And that's why I'm telling you that professional level group account is more complex. Sometimes they will give you goodwill in your question. Immediately they give you goodwill in your question, know that it is full goodwill method. Number two, the fair value or market value of the subsidiary shares or the market value of the subsidiary company on acquisition is given. The third one, the market price per share of the subsidiary on acquisition is given. They will give you the market price per share. And fine, you can calculate the number of shares. They will give you a number of shares. So when you calculate your number of shares times market price per share of subsidiary, you can get your NCI value at DOA. That means at date of acquisition. Then D is the fair value of NCI. Sometimes they will give you, that means examiner is very, very nice. Examiner is very, very nice. Examiner will give you the NCI value as a date of acquisition. Please, if you can still see my screen, let me go to this my sixth slide. This is it. This is where I'm actually talking about. This value, this determination of goodwill. Determination of goodwill. Cost of parent company cost of investment, add NCI value at DOA that I highlighted now. This value that I highlighted now. This value, NCI value at DOA. There are sometimes you calculate it. There are sometimes examiner will give you, and immediately you cannot get this NCI value at DOA. I think you are going to lose a lot of money because you cannot get your goodwill, you cannot get the value of goodwill, you cannot get the NCI value correctly. But it is very, very easy. Don't let me just please just let's just take note. So those are the four instances. Immediately examiner give you these four. It is full goodwill method you are using. But if the examiner did not give you this, please, it is proportionate net asset method. And that takes us to the second topic. What is proportionate net asset method? This is also referred to as old method. It is method of net, it is called net asset method. You can call it proportionate asset method. It is based on applying the NCI percentage on the subsidiary net assets. In this method, the calculated goodwill belong to belong to only parent company. Only parent company. That's the difference. When you calculate goodwill, especially negative goodwill, it is only parent company that will enjoy it. Remember, negative goodwill is an income, while positive goodwill is an asset. So also impairment loss will be suffered by both of them. So I wish I can just okay. Time has gone. We can't solve any questions today. So I'll send this slide. Okay, I'll send the note to you. I don't need to send this slide. I will send the note so that people at office you can print it. I will send the note to you. So I think that's where we are going to stop. Although there are so many adjustments, okay, that's why we are going to be treating past question. So I think I can take questions now. So these are the principles and the basis of group accounts that we need to understand. Example, please let's look at the principles of consolidation. Assets and subsidiary of the parent company must be added together. Only the parent company share capital will be shown. Only the NCI will be shown. Intercompany transaction will be eliminated. Unrealized profit will be eliminated. Those are the principles. Once you can understand that principles, group accounts will be fine. Although the way ICANN is doing since last diet that they are setting foreign subsidiary. I think foreign subsidiary is also a problem. They tested it last diet, they tested it last two diets. So, but the principles still remain the same. Please don't let ICANN people us. Don't let them people us. Not the same thing. The principle remain the same. Just like that last diet question, when I saw it, all you need is just to convert the financial statement, convert it to the local currency, then you now consolidate. So somebody was raising up questions before. Okay, maybe the person is now fine. Okay, Mr. Teslim. Can you Mr. Teslim, can you go ahead with your question?
Yeah, good evening, facilitator. Good evening, everyone. My question is, I need an explanation on why it's backing on purchase. I mean the negative goodwill. Why is it an income, and how is positive goodwill an asset? Thank you very much.
Okay. So okay, now can people still see my screen? Can you still see my screen?
Yes, please.
Yes,
Yes, we
Yes,
can
we
see.
can.
Okay. I want to show you now. That's actually a great question. Let
No,
me show.
sir.
Please, okay. If you can't see my screen, I think I can guess it's your. Because majority can see my screen. I think it's your network. So now, Mr. Teslim, this is where we are going. Goodwill. Why is it positive? Why is it negative? Negative goodwill is an income. Positive goodwill is an asset. Then negative goodwill is a gain on bargain purchase. So now this is where we are going. Look at the calculation of the goodwill. The cost of investment, how much you bought an investment. Let's say, example, let's say 500 million. You bought an asset 500 million. You bought a subsidiary 500 million. Then the NCI value at our DOE is 50, right? Now, your purchase consideration will be how much? 550. Now, the subsidiary net assets as our DOE is now, let's say, 600. Okay. In this example, now, our purchase consideration is 550, right? Okay. Don't let me use 600. Let's try it. Let me use 500. Now, in this question now, you can see that positive goodwill. We have a positive goodwill, Abby. We have a positive goodwill. Do everybody agree with me that this is a positive goodwill? Because according to the definition, this is the excess of fair value of purchase consideration, excess over the subsidiary net asset. Everybody, you agree with me that this is a
Yes.
positive. Okay. So, okay, thank you. In a layman language, what this things means is that the net asset of the subsidiary is 500. That means the subsidiary worth 500 million. The net asset, the worth of the business of that subsidiary, the worth is 500 million. You now paid what? You now paid 550. That means you paid more, right? So that 50 is an asset because it is telling you that you paid more for that. The reason why you are paying more for the net asset of that subsidiary is because the subsidiary has a goodwill. Mr. Teslim, hope you are getting me. I will recap again. Let me explain again. The net asset of the subsidiary is 500 million. That means, in a simple man language, it means that that asset, that company worth 500 million. The asset of this company worth 500 million. You now paid more than 500 million. So for you to pay more than 500 million for that company, for you to buy that company, for you to gain control, it means that that company has a goodwill. That means that company is valuable. That is the reason why this goodwill is positive. And that is why it's an asset. So the 50 is an excess. That means you paid more for it. And that is the reason why IFRS 3 now says that you should recognize it as an asset in the consolidated financial statement, because you paid more for it, and it's because that company is more valuable. You sweat before you buy that company because you paid more for it. The worth is 500, you now paid more. Now, let me now change the scenario now. That first one is assets. I think that one is clear. Now let me now tell you the reason why negative goodwill is an income. Now let me now use it like this. Now the purchase consideration is 550, right? Now the net assets of that company is now what can I use? Okay, let me just use 600. Let me just use 600. Now in this second scenario, the company worth 600 million. Mr. Teslim, are you there? The company worth
Yes, I'm with you, sir.
the company worth 600 million. The value of the company is 600 million. You now bought it at 550 million. Did you gain or you lost? The company worth 600 million.
It's a gain. I understand. No, it's a gain.
Can you see that it is a gain? So that gain is an income. That is the reason why they call it gain on bargain purchase. It is an income. And that is why they call it negative goodwill. It is an income to you because you paid less. That company is worth more what you paid. In court, like a plant that was 600 million, you now bought it for 550. That you gain. So that is why it is called income. And that income should be recognized in the consolidated retained earnings. So that's just the simple logic about positive and negative. Negative is an income, while positive is an asset. So that is it. Hope my explanation is well. Hope you understand my explanation now.
Yes, sir. Yes, sir. We understand, sir. Thank you very much.
Okay. All right. So okay. Mr. Benjamin, okay. Your question.
Okay, yeah, thank you very much. I really appreciate that. Okay, while you were tutoring us, you made mention of tangible assets that you said they are to be depreciated, and it's like you said the other one is to be amortized. I think intangible assets, and you
Exactly.
said goodwill should not be amortized. So,
Yeah.
if goodwill is an intangible asset, why then should it not be amortized? But you
Okay.
mentioned something about impaired. I really want to even understand what that impairment in layman terms mean and why goodwill should not be amortized since it's an intangible asset.
Okay.
Thank you.
Okay. Okay. So talking about intangible assets, the standard that discuss extensively about intangible assets is IAS 38. IAS 38 talks extensively on intangible assets, the definition of intangible assets, the types of intangible assets, the recognition criteria, and the likes. So where I'm now going is that intangible assets is very, very similar to PPE. You know, when we discuss about PPE, PPE is what? PPE is a tangible asset. A tangible asset. Why intangible asset is identifiable non-monetary assets, something that can be identified, but you cannot see it or touch it. So where I'm going is that when you are discussing about intangible assets, it must be amortized, just like tangible assets, PPE. You must depreciate PPE. It is a must. You must depreciate it. And that goes for intangible assets. You must amortize it. The another name for depreciation, when you are talking about depreciation, it is tangible asset. But when you are talking about intangible asset, you cannot depreciate intangible assets. You can amortize it. It is the systematic allocation of depreciable amount of an asset over the estimated useful life. That is depreciation, and that goes for intangible assets too. Example of intangible assets are copyright, goodwill, trademark, licenses, and the likes. So where I'm now going is that IAS 38 now gives some exception rules. The exception rule is that assets with indefinite useful life must not be amortized, cannot be amortized. Assets with indefinite useful life, asset that the useful life cannot be identified, you cannot amortize it. And that is where goodwill comes from. It is an exception in IAS 38 that you can never amortize intangible asset that is indefinitely, that the useful life is indefinitely. A great example is goodwill. But what? But you must amortize it, you must assess it, you must test it for impairment, at least on annual year basis. It is the requirement of IAS 38. And what is impairment? Impairment is, in a simple layman, is economic loss in the value of assets. Economic loss in the value of assets. And a simple example my lecturer gave me then is that you have a machine that used to produce. That machine, where you bought it for, let's say, 50 million naira. In your factory, the machine is working perfectly, is doing fine, you are using it to produce and it is fine. Unfortunately, something now happened in your factory. Fire incident. You don't know where that thing comes from. Then the factory now got burnt. So immediately the factory got burnt, it now destroy your machine. Do you agree with me that you bought that machine for 50 million, but immediately the fire has destroyed so many things in your factory? When you take that machine to the market, due to that fire, you cannot sell that machine for 50 million naira again. You cannot sell it. So invariably it has impaired. So that is why I said it that for in final level, you need to read a lot of standards. And unfortunately, we don't even have much time. If we have discussed about intangible assets, IAS 36. So when we are discussing about this, I talk about IAS 38. I talk about IAS. IAS 36 is talking about impairment of assets. There are two triggers that triggers an asset to be impaired. There is internal factor and external factor. They call it internal triggers and external triggers. One of the internal triggers is this fire. One of the external is government policies, high inflation, high interest rate, and the likes. There are some things when they happen to your assets due to high inflation rate, the assets will reduce value. So in a layman term, impairment means economic loss in the value of an asset. An asset that worth 20 million naira today, due to one reason or the other, the value might fall to 10 million tomorrow or 5 million, just due to one unfavorable condition. So that is what they call impairment. So hope I answered your question.
Yes, sir. Thank you very, very much. And lastly, sir, please, sir, could you do us a favor by dropping like your phone number and your name on the group chat, please?
My phone number is already. Maybe I was the one that dropped the message this evening. I dropped the message.
Okay, sir.
So my
All
phone
right,
number
sir.
is there. My name is Taufik. My name is Sulaiman Taufik Abiye. So my name is Taufik. So there's no problem. If you have any question, although I'm a very busy person, but just drop your question. I'll do what I can do. So okay. Miss Eniola is finally back. I think she raised her hand, and if I can get it right after Miss Eniola, I think I can go and take my dinner. Okay. We have Mr. Taiwo or Mr. Hussein. But yeah, let's take those two questions so that we can call it. Sorry, excuse me. Okay, Mrs. Eniola, you can go on.
Good evening, sir. Thank you very much, sir. So, please, my question is on the impairment on goodwill. You said impairment cannot be reversed. That,
Exactly.
for example, you said if we buy an asset for 5 million and then it had an impairment of 1 million, that for that year it will be the carrying value will be 4 million. Then,
Exactly.
if peradventure next year we tested it for impairment and we now see that it is now 5 million, that the value will still remain 4 million. I don't understand that, sir.
Exactly. And that goes to the requirement of IS 36. So when you want to test impairment, majorly when you want to test an asset for impairment, you also test CGU. CGU is cash generating unit. So, but let me just cut the long story short. It is the requirement of IS 36 that impairments cannot be reversed. That is exactly what I'm now saying. That 1 million, last year it was 4 million. The carry amount was 4 million. So when you now test that asset again, you now discover that the recoverable amount is now higher. That means it's now 5 million. You're supposed to return it back to 5 million. I statistics now say no, you cannot test, you cannot return, it cannot be reversed. That is the standard. So that 1 million will be added to another item. That means another element of financial statement, depending on the circumstance. And fine, okay, God willing, I'll try to take care of your statistics and we'll try to solve a question on it. I think I've seen one past question on it. And I will now show you how they treat that one. But just take it at the top of your mind that goodwill can never be reversed. That's the standard for. So
Okay,
that
sir. Thank you. But sir, can
uh,
I ask a question, sir? Please,
okay.
assuming what if we retested it instead of from that 4 million, we now discover that it is 6 million. What will happen?
From that, that's the same thing as 5 million now, Abby.
Okay.
You said it that next year now it is now 5 million.
Yes.
So immediately it is now, even though it's 5 million, even though it's now 7 million, even though it's now 8 million, you cannot reverse. That's what the standard is saying. Sorry, let me take this. Let me take this one. Sorry, I'm sorry.
All right, sir.
Okay, so okay, I'm back. I quickly just want to receive a call now. So that's it. You cannot be reversed. Let's just take it like that. I'll try to solve the question on it. You see what we are saying. So Mr. Hussein, I can see Mr. Hussein. Okay, I think he's fine now. Okay, I think that's all. By the grace of God, next week, I think we can start solving past question. Hopefully, I think I will change it to that. I'll change our time. Okay, let's see how it goes. Um, that's. I think that. Okay. Do we have? Okay. Do we have?
I'm fine.
Okay.
What's up? Where are you?
I'm in
Uh,
my room.
I said you come back to Abuja.
Ah,
There's no reason to come back like that.
hello.
I did not get that.
Okay, please. I think that's what we are going to talk tonight. We don't have any question again. So please, there's work tomorrow. Please, let's go and have a lovely night's rest. I thought Miss Gloria actually may want to ask a question, but
Please help us to send that note, as you said.
I'll send it. I'll send it now. I'll send it immediately. I'll send it
Thank you, sir.
like all right. All right. Okay. All right. Good night, everybody. Good
Good
night.
night.
Good night,
Thank
sir.
you so much.
Good night. Bye.
Good night. Thank you so much.
All right. Good night, sir. Good
Thank you
night.
so much, sir.
You're welcome. Good night.
Good night, sir. Thank you very much.
Yeah.
Good night, sir.
Good night. Good night, sir.
Thank you so much, sir.
You're welcome. Good night.
Yes, sir.